Right now, your mortgage lender is making somewhere between 40 and 200 basis points on your loan, and they will never, ever volunteer that number. That markup, it's called the pricing spread, and it's the difference between the wholesale rate your lender actually pays to fund your mortgage and the retail rate they hand you across the desk with a smile. On a $400,000 loan, that spread quietly costs you between $38,000 and $76,000 over 30 years. And here's what makes this infuriating. The spread is negotiable. Most borrowers just never know it exists. Today, we're going to dismantle how mortgage pricing actually works, from the bond markets to your closing table, and by the end, you'll know exactly how to claw back 1/4 to 0.5% off your rate. That's real money. Generational money. Let's get into it. When you go to Bankrate or NerdWallet and see today's average mortgage rate, say 6.75%, you're not looking at a real rate. You're looking at an average of retail rates that already have lender profit baked in. Think of it like the sticker price on a car. Nobody in the industry expects that number to be final. But unlike car buying, where everyone knows you're supposed to haggle, mortgage borrowers treat the quoted rate like it was handed down from the Federal Reserve itself. It wasn't. That rate was constructed. And once you understand how it's built, you can start taking it apart. Let's kill the biggest misconception in mortgage lending. When the Federal Reserve raises or lowers rates, they're adjusting the federal funds rate, the overnight rate banks charge each other. Your 30-year fixed mortgage is not tied to that rate, not directly. Your mortgage rate is primarily driven by the yield on 10-year U.S. Treasury bonds and, more specifically, by the price of mortgage-backed securities. When the Fed cut rates by a full percentage point between September and December of 2024, the average 30-year mortgage rate actually went up, from about 6.1% to 6.7%. That confused a lot of people. But it makes perfect sense when you understand the bond market is doing its own thing, pricing in inflation expectations, government debt levels, and global demand for safe assets. The Fed sets the floor. The bond market builds the house. Here's where it gets interesting. After a lender gives you a mortgage, they almost never keep it. They bundle your loan with thousands of others and sell them as mortgage-backed securities, MBS, to investors on Wall Street, pension funds, insurance companies, foreign governments. These investors buy MBS because they want a predictable stream of monthly payments, your payments. The price investors are willing to pay for those MBS on any given day determines the wholesale rate. When MBS prices go up, yields drop and wholesale mortgage rates fall. When MBS prices drop, yields rise and rates climb. This market trades every single business day. The wholesale rate is moving constantly. Your lender watches this market the way a day trader watches stock tickers. They know to the basis point what it costs them to fund your loan, and then they add their margin on top. So now we reach the part they really don't want you to see. On any given day, there's a wholesale rate, what it actually costs the lender to originate your loan, and there's the retail rate, what they quote you. The gap between those two numbers is the lender's gross revenue on your loan. Industry data from the Mortgage Bankers Association shows that the average production revenue per loan was about $11,000 in the third quarter of 2024. On a median loan amount, that translates to roughly 270 basis points of margin. Now, some of that covers legitimate costs, underwriting, compliance, overhead, loan officer compensation. But a significant portion is pure profit margin, and it varies wildly from lender to lender. One lender might operate on 100 basis points of margin. The big retail bank across the street might be at 250. Same borrower, same credit score, same property. Completely different rate. Before the 2008 financial crisis, there was a practice called yield spread premium, where a mortgage broker would deliberately put you in a higher rate than you qualified for, and the lender would pay the broker a bonus for delivering that inflated rate. Dodd-Frank regulations in 2010 technically eliminated yield spread premiums by name. But here's the thing, the economics never went away. They just got repackaged. Today it's called lender-paid compensation, or it's buried in the servicing release premium. The mechanism is identical. If a loan officer locks you at 7% when the par rate, the zero markup rate, is 6.625, that spread generates revenue. Some goes to the company. Some goes to the loan officer's commission. According to a 2023 Brookings Institution analysis, borrowers in minority communities were still paying an average of 20 basis points more in rate markups than comparable white borrowers, suggesting that discretionary pricing hasn't gone away. It's just less visible. The single most important concept in mortgage negotiation is the par rate. The par rate is the interest rate at which the lender makes zero markup on the rate itself. Their revenue comes only from origination fees. Every morning, lenders publish internal rate sheets to their loan officers. These sheets show the par rate and then show how much additional revenue the company earns at each rate increment above par. For example, at par, let's say 6.5%, the lender earns 0 on the rate. At 6.625, they earn 25 basis points. At 6.75, they earn 75 basis points. At 7, they earn 150. That's 1.5 points on a $400,000 loan. That's $6,000 generated purely from the gap between par and your quoted rate. These rate sheets exist. They're real documents. And while lenders aren't required to show them to you, mortgage brokers are required to disclose their compensation. That's a critical difference we'll come back to. This is where knowledge becomes leverage. There are two main channels for getting a mortgage. Retail lenders, your big banks, your Wells Fargos and Chase, employ loan officers who sell only that bank's products at that bank's margins. Then there are wholesale mortgage brokers. Brokers don't lend their own money. They shop your loan across dozens of wholesale lenders and find the best rate. Here's why that matters. Wholesale lenders compete on price because they're selling through brokers, not directly to consumers. The result, a 2023 study by Optimal Blue, which tracks over 30% of all U.S. mortgage rate locks, found that broker channel rates were on average 35 to 60 basis points lower than retail channel rates. On a $400,000 loan at 7% versus 6.5%, that's over $43,000 in total interest savings over 30 years. And yet, 70% of borrowers still go directly to a retail bank. Because nobody told them this option existed. You don't need a Bloomberg terminal for this. There are free tools that show you roughly where wholesale rates sit on any given day. Mortgage News Daily tracks MBS prices and translates them into estimated rate movements in real time. The website is free. Bookmark it. When you see their reported rate, that number is closer to the wholesale or par rate than anything Bankrate shows you. Another tool, the UMBS 30-year Fannie Mae coupon price, tracked on most financial data sites, tells you exactly what's happening in the MBS market right now. If UMBS prices are rising, rates are falling. Simple inverse relationship. Walk into any rate negotiation armed with that day's MBS pricing, and you've immediately signaled to your loan officer that you understand the game. That alone changes the dynamic. They know they can't inflate the margin as easily when the borrower can see through the markup. Here's the playbook. Step 1, get quotes from at least 3 wholesale mortgage brokers, not just retail banks. Websites like findamortgagebroker.com or the AIME broker directory make this easy. Step 2, pull the same-day wholesale rate from Mortgage News Daily. Now you have a benchmark. Step 3, when a broker quotes you, ask directly, what is the par rate on this program today? They're required to disclose their compensation, so this isn't an unreasonable question. If they dodge it, move on. Step 4, compare the spread between par and your quoted rate across all 3 brokers. The one with the tightest margin wins your business. Step 5, and this is where the real savings happen, use competing loan estimates as leverage. Under the TLA-RESPA integrated disclosure rules, every lender must give you a standardized loan estimate within 3 business days of application. Get 3 of them. Put them side by side. Call each lender and tell them exactly what the other 2 quoted. According to Freddie Mac research, borrowers who get 5 or more quotes save an average of $3,000 over the life of their loan versus those who only get 1. 5 quotes. $3,000, just for making a few phone calls. Let's make this concrete. On a $400,000 loan at 7% over 30 years, your total interest paid is $558,036. Drop that rate by just 0.25% to 6.75. Your total interest falls to $534,206. That's $23,830 saved from a 0.25% reduction. Now knock off 0.5%, 6.5. Total interest, $510,177. That's $47,859 you kept instead of handing to a bank. And here's the kicker, you didn't refinance. You didn't pay points. You didn't do anything except understand the pricing structure and negotiate before you signed. $47,000. That's a child's college fund. That's 3 years of retirement savings. That's a down payment on an investment property. All from knowledge that takes 20 minutes to learn and costs you absolutely nothing. Every single mortgage rate you've ever been quoted was a negotiation you didn't know you were in. Now you know, the wholesale rate exists. The spread is real. and the tools to find both are free and available today. If this breakdown saved you from leaving money on the table, share it with someone you know who's buying a home this year. They'll thank you for it. Subscribe if you want more of the mechanics behind the biggest financial decisions of your life, because understanding how the system actually works is the only edge that never expires.